Good afternoon, everyone. My name is Nicole Wynn, and I'm the Director of Life Insurance Sales here at InsureMark. I wanted to first thank everyone for taking the time this afternoon to join us on this webinar. Today, we're going to cover a very surprising way that you could pay for college using life insurance. According to the College Board, earning a college degree now can cost from $52,000 to more than $130,000, and that cost is rising faster than inflation. There are many different ways that you could fund for a college education, but even with grants, scholarships, and other funding options that are available, many people still find that there's a gap between the available funds and the cost of college. So that's where Indexed Universal Life can help bridge that gap. One of the hottest IULs in the marketplace right now for college funding is Allianz's Life Pro Plus product with their new trigger method indexing strategy. This strategy is probably one of the most innovative since the inception of Indexed Life, and its simplicity is great for a low interest rate environment. With the trigger method, it's pretty simple how your clients can calculate their returns. So if the index is greater or equal to 0%, then your client earns a 9% rate of return on their policy. So right now, I'd like to go ahead and introduce Ryan Kitzman of Allianz Life, who's joining me today. Ryan, I'll go ahead and turn this webinar over to you so you can show advisors how they can position life insurance for college funding.
Sounds great, Nicole. Thank you very much. And as we get this pulled up here, I'll get my PowerPoint set up, and then we should be good to go. So, as Nicole mentioned, my name is Ryan Kitz. I'm the Senior Internal Life Wholesaler here at Allianz, and I work with the fine folks at InsureMark and a lot of the agents underneath InsureMark. So what I'm going to be talking about today is a little bit around college funding, specifically using life insurance. Now, as everybody says, you know, it's important to have a lot of different tools in your toolbox, and this is definitely one of the tools you should be having in your toolbox. Not only is cash value and index universal life insurance becoming more and more popular, but it's becoming more and more popular as a strategic planning method to use towards college funding compared to some of the other options that are out there, or using it with some of the other options that are out there. So as I go into it today, hopefully I'll give you some details and some more information if you aren't already using it, or even if you are, just get some different specs and information on using life insurance, as well as some case studies that we'll be able to run through on actual cases that we're running with this type of strategy. So I'll go over first with some of the things Nicole mentioned, some of the rising costs and different things that college is becoming such an important tool out there for individuals to get a college degree, college education, becoming more and more a topic for parents to talk about, of what they can be doing to help their kids funding that college education. We'll go through some of those costs, and then we'll go through some of the ideas around life insurance being one of those tools. So if we take a look at costs, and Nicole kind of touched on this as we're looking at this, but the costs are pretty incredible, and I'm sure you guys have seen these statistics, and every time I look at these or go through this presentation, it starts to hit home more and more in regards to where these costs are going and where they have been before. Because if you look at, whether you're looking at a private college being as much as almost $250,000, or if you're looking at just regular room and board on a four-year public school, it's jumped almost 84% from 2000 to 2010. So costs have increased dramatically over the recent time frame. And even costs of private institutions have rose about 49% during the same period. So a lot of those things are going up, but at the same time, what else is going up when costs associated with college, not only room and board, but also college textbook prices have increased faster than tuition. I think Nicole mentioned that. But some of these statistics are crazy to think about, and it's important to understand from an agent standpoint, but also from a client standpoint, on what we'll need to do to put away as much as we can, for that matter, into tools and vehicles that will help us pay for these rising costs that are going into the future here. So, because ultimately it comes down to the parent's decision: is this going to be worth it for my child? Is college worth it? And that's obviously for the parent and the child to decide. But look at some of these statistics here. If you look at a 2011 college graduate, earned $42,800 on average last year. their peers that only had a GED earned just on average $23,500. So quite a big difference in regards to having a college degree versus not having a college degree. But you also look at college graduates are the only group that has more people employed today than when the recession started. So quite a few years ago, looking back at that. But just some fun statistics to take a look at. And even more important, the topic that's on everybody's mind, unemployment out there. We look at the national unemployment, you're looking at about 7.5% as of April 2013. College graduates are only about 3.9%. People with a college degree. So obviously statistics don't lie. It's important to get a college degree. I think the majority of clients out there that you're talking to agree on that. But ultimately they may not have the means or the ability to get to that point to help their child pay for those college kind of expenses. Because you look at these, even though it may be a priority, look at the difference between an average planned savings per child versus the average actual savings per child. Quite a dramatic difference, right? We're looking at $38,900 that's planned to be saved, and only about $19,780 actually gets saved. So there's a big gap in regards to what we want to do versus what we're actually doing. So we need to really help gear them towards making sure we're putting these dollars away because we know what those costs are at. We know what a college degree can do for our children, but what can we be using towards that? Well, there's a couple different options, obviously. We have grants, there's scholarships, there's things like 529 plans, Coverdell's. There's all these kind of options out there. So it's up to us, I guess, to help the client determine what is going to be the best option for them in regards to what they can fund their money into to use for these college types of expenses. So looking at all these different options, I'm not going to say one is better than the other, and I'm not going to say life insurance should be the only option you should ever choose for college funding, because that's definitely not the case. Life insurance can be one of the tools that you use towards college funding, and as a vehicle for cash accumulation purposes, but also for death benefit oriented, it is a vehicle that is getting used more and more for college funding, either as a supplement to one of the other options that they're doing, or maybe a larger chunk of one of the other options that they're doing, but it's getting used more and more. So let's take a look at maybe why that would be here. Well, number one thing is America is underinsured, right? You look at some of these statistics here, 50 million Americans have inadequate life insurance. 40% of adults have no life insurance whatsoever, which is a crazy statistic to think about. And you look at some of the widows or widowers, there's a good chunk of them that felt their spouse had adequate life insurance, or a smaller chunk, excuse me, that felt like after the individual passed away, they had enough life insurance to take care of the needs that they needed to continue to take care of, whether that's a mortgage or college expenses, whatever it is. But the best statistic, I think, is on the right-hand side, because that shows the opportunity, not only with life insurance in general, but using this type of concept with life insurance. And you see only 39% of Americans recall even being offered life insurance in the past 2 years. It's a very small chunk of individuals, much less than half, even remember being offered life insurance as part of a plan that they're doing in their financial picture. So there's definitely opportunity out there in regards to what we can be providing for our clients, and something that they probably don't even think about, or maybe we're not even thinking about as much, as life insurance being one of those vehicles. And I think as we look at those statistics, the information on this screen being one of the main parts of that death benefit side of things. I mean, the death benefit's there to replace some of these things, like income replacement, resources for college funding, mortgages and expenses, all that kind of stuff before the child gets to college. What happens if the parent isn't around to help pay for college expenses? Well, you need to have something in place until you get to that point. So this is almost your to and through your children getting through college. Just as you maybe heard to and through retirement, same kind of idea. This is your to and through your children getting through college, making sure you have the death benefit side of things taken care of in case something were to happen to you or your spouse beforehand. So ultimately, that's the first thing we need to make sure that the client actually, one, is insurable for that matter, but number two, has a need for life insurance, which as we looked at those statistics, there's many people out there that do have a need for life insurance. But the other side of the coin is really the advantages of the cash value accumulation potential within these products. And I think this is becoming more and more popular with cash value life insurance in general, actually utilizing the cash value in the policy to take some kind of tax-free distributions for whatever that is, whether it's college funding, supplemental retirement income, whatever they may be using it for, just for a rainy day kind of fund. You have the cash value ability within a life insurance policy. And it's becoming more and more popular with the taxes, national debt, all this kind of stuff going on. People are looking for a vehicle that has these types of potential. But more importantly, I think people are looking at indexed universal life products as this cash value vehicle for a lot of different reasons, but probably more is because of the last 10 years where the economy been, what the markets have done. We've had a couple different downturns. They're looking for something where they can have downside protection, but they also get upside potential. And that's really what an index universal life offers. It has the index strategies within that type of product that offers some kind of floor, depending on what index strategy you're in, but also offers that upside accumulation potential. So especially when you're thinking from a client standpoint, they're saving for college, the last thing they want is the money that they're putting away to actually decline or go down from market performance or from what they're invested in. So by having an index product that has index strategies that have floors on them where they're not going to have a negative return is very important. And as Nicole mentioned, one of our stronger indexing strategies for especially a little bit more conservative type of client is that trigger method. Great in this type of strategy saving for college funding because you have some consistency. Right? Anytime the S&P 500 is flat or positive, the client would trigger a 9% credit for that year. So the client is going to know if S&P 500 is up, I'm going to get 9% in my accumulation, or 9% credit for my accumulation value. So it gives them some consistency. It gives them some comfort in the fact that they know they're not going to have a negative return, but at least they have some upside potential that they'll be able to accumulate some money towards these types of events like college funding. So becoming more and more popular using that cash value within the policy. And really the component of it towards the college funding strategy is because you can take out those loans tax-free, right? Like your 529 plans or your Coverdell's, the tax-free is really an advantage. The growth that you're taking out is coming out without any taxes on it. But the real benefit or flexibility around a life insurance policy is that you can take those tax-free loans out for anything you want. And before any certain restrictions on ages or anything like that, the flexibility of when you take out those tax-free loans and for what is very large. Much different than your 529 plans or Coverdell will have to be taken out on kind of your qualified types of expenses for college. This can be taken out for whatever it is. So there's a lot of flexibility in where those tax-free loans come from, but also a lot of flexibility in how much you can fund into a life insurance policy, obviously staying within the guidelines. The bigger kicker as well is that there's no college funding eligibility requirement, so it doesn't count towards FAFSA or anything like that, which is typical for a 529 plan, maybe something else counting towards FAFSA requirements or help for financial aid. Life and cash value life insurance does not get counted towards that currently. So again, it's a part of what should really fit in as your overall strategy towards college funding. With a lot of these different options out there, fixed index universal life can definitely be one of those. I'm not going to go too in-depth into this, but this comparison between a 529 plan and a life insurance policy is on our college funding consumer brochure, which is available in our college funding kit here at Allianz. And it goes through some of the differences between a 529 plan and a life insurance policy. It breaks down what are some of the pros and cons, obviously, or restrictions and not restrictions for that matter between those two different ones. The biggest one out of all these is probably going to be one, your 529 plan contributions, how much you can actually contribute to a 529 plan. There's some limitations in regards to the gift taxing limits. There's also the limitations in regards to what you take that 529 plan out for. If you don't take it out for qualified expenses, you'll still get taxed potentially on the growth within that 529 plan. And then that last one, what we've already talked about, is the 529 plan. A portion of it does get counted towards FAFSA or financial aid type means. So we got to couple that with the life insurance policy benefits of being able to contribute a little bit more if the clients are able to, being able to take out the flexibility of the tax-free loans for whatever they really want and not getting counted towards FAFSA. It's a great complement for each other between the two. And again, look at more in depth than these in our college funding consumer brochure. We'll break those down in depth. But let's take a look at an actual case here, and I actually have two of them I'm taking a look at. This is a single mother, has a 2-year-old daughter. She doesn't have any life insurance coverage right now, so she needs to get life insurance coverage on her. In case she were to pass away, it goes on to whatever guardian is going to take over for her child, giving them the money to help care for that child, but also help fund her college expenses if she wasn't able to help pay for those expenses living and later on in life. And this particular mother was also contributing towards a 529 plan, so it's coupling this index universal life policy with a 529 plan. She has a 30-year-old female, preferred non-tobacco. She's able to fund away about $5,000 per year. And you look at 16 years down the road, the child gets to age 18, and they started taking distributions out of $29,545 per year for a 5-year period. So they were able to take out a really good chunk of money coupled with whatever they're able to take out of their 529 plan as tax-free distributions to help pay for those college expenses. The other thing to think about with an index universal life policy is a lot of these policies, especially ours, have what's called a participating loan. And without getting too much into that, what that offers is your accumulation value to still earn whatever the index strategy is earning while you have it loaned out. So you have your money working for you while you have it loaned out. So it's a pretty unique strategy within an index universal life insurance type vehicle that doesn't really get offered in any other investment vehicles out there. So that helps out with some of these distributions. The other illustration that we look at here is a different type of scenario. We have a husband and a wife. Jim's 35, Julia's 29. They have 2 children that are twins. Jim already has adequate life insurance coverage on him through term and through his work, but Julia doesn't have any. She's self-employed. She doesn't have anything through her work, obviously, so she's very underinsured. But they also want to put away what they can for college funding for their 2 twins. But what they're also going to be doing in this scenario is that they're going to actually continue to fund this life policy for Julia's supplemental retirement income. Because she's self-employed, she doesn't have any other investment plans towards retirement accounts or anything like that, so she's going to also use this policy for that means as well. So now we're looking at funding $10,000 away. We get the death benefit coverage of $600,000 on Julia to make sure she's adequately insured, but then we're also looking at not only taking out distributions for college for the 2 twin children, and that looks at about $67,600 per year for 4 years, but then continue to fund it away $10,000 again into the policy until Julia gets to age 59, and then at age 60 she's able to take out supplemental retirement income for herself of around $72,250. So pretty impactful that she's able to take advantage of not 3 goals, right? The life insurance coverage she needed, college funding she wanted to do for her children, and supplementing her retirement income. So pretty key in regards to offering that. Also, one last thing I want to touch on is regards to the marketing materials we have here. There's some really good marketing materials in our college funding kit. We have a full kit with consumer brochures, some of the main ones being just the college funding consumer brochure in general, as well as grandparents brochure. And we're getting a lot more traction on that, where a grandparent is actually funding premium towards their adult child to help save up cash value in a life insurance policy towards college distributions for their grandchild. So there's a really nice brochure in there called Creating a Legacy for Grandparents. And then some of our real-life stories are obviously important to take a look at as well, because they have some more impact in regards to real-life scenarios that have actually happened. So, and the main purpose of looking at life insurance is another tool that offers some different features that some of the other college funding vehicle tools out there don't offer. So make sure to be looking at both of them, seeing which one fits the client scenario the best, and ultimately at least having life insurance is maybe one of those options to get the death benefit coverage so they have it to the college experience and also utilizing the cash value through that college experience. So that's what I wanted to touch on today, Nicole. Keep it short and sweet. So I don't know if you want to open the line up for any questions or maybe any other information you want to provide here. Nicole, are you still there?
Oh, sorry about that, Ryan. I had myself on mute.
No.
Thanks a lot. I wanted to go over quickly here InsureMark's College Bound Rewards program, which ties in perfectly with our webinar topic today. With this program here, our advisors have the ability to give away college-bound students up to 1 full year's tuition for free. So last year alone, over $25 million in scholarships was given away to over 200,000 students across the country. So we don't have enough time today on this webinar to go over the details of this, but I would encourage everyone on the webinar today to go ahead and call into InsureMark and ask to speak to your marketer about this program here. The second item I want to cover real quick here is our IUL boot camp. Our next Index Life boot camp that we're going to be hosting here at InsureMark at our home office in Houston, Texas is going to be November the 13th through the 15th. The specialized training is designed for agents that are looking for an attractive or alternative way to do retirement planning through IULs. Or this is for your annuity agents that are tired of the low interest rate environment and have huge books of business and are looking for alternative revenue streams. So if this sounds like you on the call, give me a call after this webinar this afternoon, and we'll see if you qualify for this all-expense paid training. And the last thing I want to cover here is a special incentive for those of you who are on the call this afternoon. This is only good for the folks that are actually on the webinar. So for those that are listening to this on a replay, you do not qualify for this here. So we're going to give out a Kindle Fire HD. So it's a 7-inch tablet. Be the first one on your block to get one courtesy of InsureMark. And a couple of ground rules to be able to get it. After the webinar, you have to call in to get an illustration run by this Friday. So we're going to give you 4 days to call into InsureMark, ask for me, or ask for anybody on the life insurance team here to run you an illustration with Allianz's Life Pro Plus product. This is the product that Ryan mentioned, has a trigger indexing method that gives your client a 9% rate of return if the S&P does 0 or is anywhere positive. Now, if you submit the case with a minimum of $200 monthly premium or a $2,400 target premium by the end of this month, so we'll give you the next couple weeks to get a case in this month, and if that case goes paid and issued in funds by the end of this year, it will give you 2 months to get this done, you will earn that Kindle Fire. So this is only good for folks on the call today. Now, if you want to get the complimentary sales kit that Ryan spoke about that helps you position college funding, give us a call back here. Our phone number is 800-752-0207. I can be reached at extension 203. You can give me a call directly. You can call to anybody here on the life sales team. Again, the phone number here is 800-752-0207. And on behalf of myself and Ryan over at Allianz, we thank you for your time today.